Navigating turbulent waters. Tips for managing investment risks during global economic downturns. In the unpredictable realm of finance, global economic downturns cast a shadow of uncertainty, challenging investors to navigate turbulent waters with resilience and strategic acumen. As economic landscapes shift and markets react to the ebb and flow of macroeconomic forces, effective risk management becomes paramount. This article delves into practical tips for investors seeking to safeguard their portfolios and mitigate risks during periods of global economic downturns. Diversification as a shield. Asterisk. One of the foundational pillars of risk management, diversification involves spreading investments across different asset classes, sectors, and geographic regions. During economic downturns, various sectors may be affected differently, and diversification serves as a shield against concentrated risk. Investors should assess their portfolios to ensure a well-balanced mix of equities, fixed-income securities, and alternative investments, adjusting the allocation based on the prevailing economic conditions. Consider a scenario where a portfolio heavily weighted in technology stocks faces significant losses during a market correction. In contrast, a diversified portfolio that includes defensive sectors such as utilities or healthcare may exhibit greater resilience. Diversification is not a foolproof strategy, but it remains a potent tool for managing risk and enhancing the overall stability of an investment portfolio. Stress testing portfolios. Asterisk. During times of economic uncertainty, stress testing portfolios becomes imperative. This involves simulating adverse scenarios to gauge how a portfolio would perform under extreme conditions. Investors can assess the impact of variables such as market volatility, interest rate fluctuations, and economic contractions on their holdings. Stress tests provide valuable insights into the potential vulnerabilities of a portfolio, enabling investors to make informed adjustments and bolster their defenses against unforeseen risks. For instance, an investor holding a portfolio heavily exposed to cyclical stocks may conduct stress tests to evaluate the impact of a prolonged economic downturn. If the results highlight significant vulnerabilities, strategic rebalancing may be warranted, shifting towards more defensive assets or those with historically lower correlations to economic cycles. Active monitoring and tactical adjustments. Asterisk. In times of economic uncertainty, vigilance is key. Active monitoring of market conditions, economic indicators, and geopolitical developments empowers investors to make timely, informed decisions. Tactical adjustments to portfolios, such as rebalancing and reallocating assets, can be instrumental in responding to changing market dynamics. This proactive approach enables investors to capitalize on emerging opportunities and shield their portfolios from potential downturns. Consider a situation where a looming global economic downturn prompts a shift in central bank policies. An investor who actively monitors these changes may adjust their portfolio by reducing exposure to interest rate-sensitive assets and increasing allocations to defensive sectors, such as consumer staples or utilities. This nimble response to evolving economic conditions enhances the resilience of the portfolio. Quality over quantity. Asterisk. In uncertain times, the quality of investments takes precedence over sheer quantity. Focusing on companies with strong fundamentals, resilient balance sheets, and sustainable cash flows can provide a buffer against economic headwinds. High-quality companies with established track records of weathering downturns are more likely to emerge stronger on the other side, making them attractive additions to a risk-managed portfolio. For instance, a company with a history of consistent dividend payments and a robust market position may be more resilient during an economic downturn. Investors emphasizing quality over quantity may prioritize such companies in their portfolios, recognizing the intrinsic value they bring in challenging market environments. Liquidity considerations. Asterisk. Maintaining liquidity within a portfolio is a prudent risk management strategy, particularly during global economic downturns. Liquidity provides investors with the flexibility to capitalize on investment opportunities that may arise during market dislocations. Additionally, having sufficient liquidity serves as a safety net, allowing investors to meet financial obligations or take advantage of distressed asset sales in a downturn. In the midst of an economic crisis, illiquid assets may become difficult to sell at reasonable prices. Investors with liquidity constraints may find themselves forced to sell assets at a loss to meet immediate cash needs. By carefully managing liquidity, investors position themselves to navigate economic downturns with greater financial agility and resilience. Staying disciplined amid volatility. Asterisk. Volatility is a hallmark of global economic downturns, and maintaining discipline amid market turbulence is essential for risk management. Emotional decision-making, driven by fear or panic, can lead to suboptimal investment choices. Investors should adhere to their long-term investment objectives, resist the urge to succumb to short-term market noise, and remain focused on the fundamentals of their investment strategy. For example, during a market sell-off, the temptation to abandon equities and move entirely into cash or defensive assets may be strong. However, a disciplined investor with a well-thought-out investment plan may view market downturns as opportunities to selectively add quality assets at more attractive valuations, adhering to their long-term investment goals. Conclusion. Asterisk. In the face of global economic downturns, managing investment risks is a nuanced and dynamic endeavor. Investors who approach this challenge with a combination of diversification, stress testing, active monitoring, a focus on quality, liquidity considerations, and disciplined decision-making are better equipped to navigate the complexities of turbulent markets. While uncertainties are inherent in the world of finance, a strategic and risk-aware approach can transform challenges into opportunities, allowing investors to weather economic storms with resilience and emerge on the other side with their portfolios intact.